Hello, everybody, and welcome to the Like a Tortoise channel. If you are new here, welcome. And if you are not, thank you so much for the ongoing support. It really helps us a lot. The goal with the community is exactly to grow it over time. And so you guys have been amazing. I continue to read all your comments and listen to your suggestions, get your feedback. So thank you so much for all the contributions so far. And yes, so if you don't know what our framework is, then by all means go back to our previous videos and you will see that we are all about selecting high quality companies that we believe will continue to compound our money over decades. Okay, but we want to buy them with a big margin of safety. Okay, so that sums up pretty much our framework. There's a lot more to it, but I like to keep it short right here. Okay, so guys, I got some of your messages about, hey, do you think the markets are crashing? So I want to no, okay? I don't think the markets are crashing. In fact, if I'm sharing my screen right now, and you guys know that I use eToro for educational purposes. This is the platform that I typically use whenever I'm showing something to my clients. Because I use interactive brokers to execute all my transactions, but this one is more user friendly, so I like to stick with it whenever I'm putting out content, right? Okay, so what you can see, guys, is that the NASDAQ is only down about 6% from its all-time highs, and the S&P is down what? 4 or 5%, and you call this a crash? I mean, guys, please. I mean, it's incredible because if you go back many years, you can see that there were periods of time where the S&P crashed 50%, 40%, and then it took 20 years, 12 years, even 18 years to break even. Okay, so we people have been so conditioned to buy the dip and see the market goes up over the last 15 years that they forget that bear markets actually do exist, and this is definitely not one of them. The markets are only slightly off their all-time highs. Look, as far as I can tell, this is just a normal, very normal pullback. I mean, look at the violent upward momentum that this thing showed from the lows from the lows reached in around March 2025. So from March 2025, the Nasdaq is up 52%. Okay, I mean, what do you want me to say? In fact, it was up about 60%, and now it just gave back some of those gains. But that's completely normal. Markets will zigzag higher. I still can't say that this is a recession, like a crash, or anything of that kind. But look, what's happening now? What I'm seeing right now is exactly what I've been warning you guys about, namely the market valuations are very, very high, and that's just, it's very, very hard to argue about it. It's very hard to argue about it, right? So you still have even against the backdrop of this decline, you can see, for example, that the Wilshire 5,000 to GDP ratio, in other words, the Buffett indicator, is at 221% of GDP. Look how disconnected we are from economic reality. In 2000, this thing was up 127%. Yeah, it was 127%. In 2007, at the peak of the financial crisis, it was about 500% of GDP, and now we are well over 200. So yes, and even if you look at other indicators like, for example, the Shiller PE ratio, look at this right here. You can see that even though we have slightly pulled back, this thing is still at 39 times. 39 times. It has only been this expensive one time in history, and that was at the peak of the 2000 tech bubble. Okay, and look at the medium at 16 times, going back to 1980. All right. So look, when this thing crumbles, and I don't know if it will tomorrow, next week, or next year for that matter, but at one point I believe we will have a reversion to the mean. This thing is just, it's going to be nasty. Okay. And those are just the natural the market forces, and these are healthy because it will allow the economy to just how can I say, it will allow the economy to reset. Okay. so that all malinvestments and all of the excesses that were produced over this time are eliminated. Yeah, so recessions are very, very good for economies as well. But unfortunately, because of central bank distortions and so forth, we are so accustomed to seeing things going up, and we fall into recency bias, believing that that same behavior will happen in the future. Well, I don't buy that 1 second. All right. So what exactly do I want you guys to know here? I want to say that, as you know, that I think we are in a AI bubble, and I think what we are seeing in the markets right now is a rotation. We are seeing a rotation out of the large cap tech names into more defensive names. Okay, and that's why some companies, for example, if I show you here, for example, companies like Meta, right, one of Wall Street's darlings, you can see that Meta has come off substantially from its highs, down what, 30% from the all-time high. So Meta is in a bear market. Likewise, if I can also, you can also see that, for example, Microsoft, Amazon. Look at Amazon, another company that is well off its highs. Okay, what's this? Okay, so this company's Meta is not yet in a bear market. For that, it would have to be down at least 20%, but it may be headed that way. So the selling pressure is mostly pronounced across the tech space. Yeah, and it comes exactly as many prominent investors are already calling, are drawing parallels, right, to the tech bubble that we saw during the year 2000. And for example, what I also want to share here with you guys is, and you can see this look what Google CEO said yesterday. He warned of this AI work. So he said that Alphabet launched, no, not this. No firm is immune to AI. Just not to blindly trust AI tools as we enter the era of AI. In fact, I don't have the whole piece here, so I will be, this is what I share with our community. This is what he said. So Alphabet's Pinterest sounds the alarm on AI bubble, drawing parallels to the dot-com era, as you can see. He invoked the term irrational exuberance, first coined by Alan Greenspan. As competition with OpenAI intensifies, he emphasized the need for sustainable growth and responsible innovation before inflated expectations burst. And what are we seeing right now? We are seeing a lot of those inflated expectations, okay? So, for example, if I go here to Palantir, right, which is certainly one of the AI darlings, you can see that Palantir currently trades at a forward PE of almost 200 times. This is crazy. I mean, is Palantir a great company? Yes, but price is what you pay, value is what you get. And what's happening right now is that people are believing that the next many years that Palantir will be able to deliver on the ridiculously high growth assumptions currently built into the stock price, right? But what if that doesn't materialize? Well, if it doesn't, what happens is, as I was showing to a client, it may take you 16 years to break even. Just like we saw with Microsoft during the tech bubble. Look at that. From 2000 all the way through 2016, 17, you made no money. And all the while, fundamentals improved. Revenues went up, earnings went up, cash flows went up. So why didn't the stock move for the ensuing 16 years? Because you were already paying for that growth at the peak of the 2000 bubble. And that's why. And I'm very concerned that we will be seeing a similar thing with some of these crazy, with some of these tech names that are trading at nosebleed valuation levels. And by the way, Microsoft fortunately managed to go on to make new all-time highs. But what if he didn't? What if the company, for example, around this time, 2016, what if competition started to eat into its market share, something like that? You know what I mean? So you don't have any margin of safety when you pay such a high price. Unfortunately, Microsoft, for those of you if you, I don't know, I mean, how old you are, and if you started investing during the tech bubble, but if you did and you still hold on to your shares, congratulations. But you know what I mean. Most people will have sold because they've run out of patience, right? I mean, who would wait 16 years for the stock to move? I mean, it's just insane. It's certainly not me, because my goal with an investment is to double my money every 3 to 4 years, and certainly companies like at these levels don't meet that criteria, not even close. This is ridiculous. Your risk reward is definitely not attractive. So I want to wrap up by saying, please, guys, just be careful. Don't use leverage. Okay. Remember that there will always be a market, and you want to be like a lion waiting patiently in the bushes. Be the tortoise. Okay. We want to be the tortoise, and we want to win the race no matter what happens, no matter what life throws at us. And in order to do that, we have to be ready to deploy capital when the opportunity arrives. And so what I was saying to people in my community is, look, just make sure you have that watch list ready. Select great companies you'd like to be the outright owner of companies, that, and then run a valuation on those companies and be ready to attack them when the opportunity comes. Okay, there are still plenty of opportunities in the market outside the AI space, that's for sure. And I invested in some, as you know, because I made the portfolio available here on YouTube with real money. And so you can still find attractive opportunities, but sure, I mean, for sure we will get even better opportunities if the S&P decides to continue its selling off, to continue to sell off. All right. So this is all I can say. Just be the tortoise, not the hare. Because if you use the framework, guys, I mean, you will make a lot of money over time. There is just no way you're not going to be able to do so, because this thing is not new. This framework has been around for decades, not even years. And it has been followed by some of the more successful investors of all time. Okay? Stick with quality, stick with your margin of safety. The three most important words in investing are MOS, margin of safety. And look, don't, like I said, don't use leverage, okay? Because otherwise you will blow up your account like I did at the beginning of my journey. Also, I wanted to share with you guys, now that I was touching on communities, I have a free WhatsApp group of like-minded people. And so if you guys are interested in learning more about it, just message me, or just send me an email. All that information is available. You can find me across social media. I'm mostly active on LinkedIn. And please please smash the like button if you found this video useful. It really helps us grow, and that way I will be able to continue to deliver and to put out more educational content for you guys. I want all of us to make a lot of money over the long term. And if you do well, I do well, and the other way around. Okay, so have a lovely rest of your day, and speak soon, everyone.